Ladies and gentlemen, welcome back to the Daily Capital Flows live stream. We are on the back of a lot of positive news for all the thesis that we've been covering on the live stream every single day. We have the topic for today, which is China trying to become the next world power and attacking global markets through economic warfare? And the reason why I intentionally chose this topic today was because we're coming off the back of one of the most important meetings that we've ever had, where you have not only Trump, not only Xi in the same room talking, beginning to negotiate and have a lot of backroom deals, but on top of all of that, you have every major CEO in the world also attend that meeting as well, among whom is Jensen, and we're all setting up for NVIDIA earnings this week. So all of these moving parts are coming together. And what I would say to you is that one of the most important things you can be thinking about right now is how we are getting more and more connected to the geopolitical changes that are taking place. When you have central banks, the currency, interest rates all overlapping so much, you move into a sort of economic and geopolitical endgame where maybe in the past you could ignore geopolitics, but now it really has consequences. And so we'll be covering that. And then also we'll have James cover some really cool topics as well to integrate into that. And we're going to start with price action and talk through that a little bit. James, how are you doing?
Feeling good. Been a really interesting 24 hours in the grand scheme of things, especially for some of the larger plays we have going on in the capital flows ecosystem. So I'm sure we'll cover that, but also very interested to hear kind of the breakdown of China, the big bad China. China's a big deal. So let's get to it.
Absolutely. If you guys are here, do me a favor, and if you're watching this on Twitter or YouTube or whatever it might be, put into the chat that you guys are here and where you guys are at. And then if you're able to reshare this, that'll mean a lot just so that everyone else is able to track along with the analysis and themes that we're laying out. And appreciate everyone showing up every single day. And again, we'll be doing these live streams every single day and breaking down all these macro concepts. And the place that I want to start is really with price action. And everyone knows about the oil prices and how they have increased over the last several months. Now, what I've been laying out ever since the oil prices increased is the time lag within it. So you'll remember that you actually had this initial, move up in oil that began to price a little bit of a premium. Rates actually fell during this time. Then on the actual oil spike, rates moved up a little bit, but not as significantly as oil itself. And that really has to do with the time lag that exists in the system with these types of physical versus financial products. And now we're seeing interest rates move a bit higher in a time lagged fashion, which directly connects to how time lags work in complex systems. If you want a great book on this, one of the books that I've found incredibly helpful is called The Origin of Wealth. And it breaks down how exactly you have time lags that occur in complex systems and how exactly you want to analyze those as well. So for example, if you have an initial shock, there is always a reverberating effect that results from that shock. And sometimes those occur with a time lag, and those time lags itself always have a moment where there's uncertainty around how that time lag is taking place, when it's taking place, and how really positioning functions around it. So the entire goal of today is to break down how exactly these time lags are working. And the first one is in this entire section with crude and also interest rates. What you'll notice is that you had the spike up in crude, and what I talked about is that this tension between headline and core CPI is the factor to watch for this time lag. And I've been neutral bonds and neutral to bearish bonds, which is why interest rates have been rising in lockstep with that. I've said, interest rates are probably going to tick up a little bit, and you don't want to be long duration here. It's not the place where you want to be long bonds and, functionally short interest rates. And what have we seen? We've seen crude remain at these levels. So the fact, and this actually goes back to why exactly I don't want to be short equities as an expression of higher interest rates. Even though we're seeing it tick around a little bit here and there, we're still remaining below these levels in crude, which tells you something. You should ask a question here. Why are interest rates making new highs, but crude isn't? And that is primarily due to this tension between headline and core CPI, where energy prices, gas prices have ticked up. The question is, how much will that feed through into the rest of the economy? Right now, we're not seeing growth in the economy begin to stagnate, and we're still seeing the consumer rise and increase in its share of GDP, or its growth as it relates to GDP. And I'm actually going to share one of the charts that I went over and posted recently, because this really will give you a view into what's taking place in the US economy. When people say the consumer is getting crushed, well, first, when people are saying the consumer is getting crushed by inflation or stuff like that, one, we can always quantify that. There's never uncertainty about it. And two, when people say, oh, well, the consumer is still spending, but it's all just inflation, it's not the actual consumer. We literally have nominal and real numbers, so we can tell the difference between that. So there's literally never a question about that. Like, maybe people are arguing about it because on Twitter, but anyone running money in any capacity is never confused about nominal and real changes, which is why all of us connect nominal and real changes to the actual underlying economy and the underlying data as it's reflected in nominal and real GDP. Like, there's a real reason why we look at nominal versus real GDP and things like the Atlanta Fed Nowcast or whatever it might be, because we adjust for that inflation. And, for example, too, in this chart, we have the consumer spending, which is running at about 2.34%. And, this has still been very resilient at these levels, and we are not seeing stagflation. So just because inflation increases doesn't mean stagflation is occurring, which just simply means if stagflation is occurring, that means growth is decelerating and inflation is accelerating. That's very different than this period of time that we have now. In the 1970s, real growth was actually significantly negative and inflation was at highs. We have never seen a period of time like that since the 1970s. And do we have comparable oil shocks to the 1970s? Yes. However, the discontinuity that exists is that we don't have real growth in the same negative territory that we did in the 1970s. And if you just look at the personal income and outlays data, you can see all of that. And so the goal is to break down those moving parts, and we're going to cover some of those. On the interest rate side, coming back to TradingView, the entire setup that we have right now, and we talked about this on the live stream, we talked about this last week, is that we have had interest rates rising for a decent period of time now. And people are beginning to think, oh, interest rates going up, that must mean bearish equities. And here's the thing. There is a very important scenario to think about for that. However, we also need to ask, wait a second, why is it exactly that the S&P 500 has rallied this entire time as interest rates are moving up? And only just recently, and again, it's not even that significant yet, has ES come back down just a little bit. You can see that as you have interest rates rising right here, that you still have a bit of, or you're still having a rally in the S&P. And then same thing right here. Interest rates are rising, S&P is rallying. Now we have this period of time. And this period of time is due to two things. One, yes, interest rates are finally having a little bit of an impact. It's marginal. And James and I actually talked about this the other day, where I said, the inflation print that we had was at this exact level right here. And so the fact that we've pulled back to it as interest rates have popped up a little bit is not surprising. We actually talked about that. I said I wouldn't be surprised to see us pull back down to the CPI level. This is where we had inflation hedges unwind a bit and people kind of got a little bit scared. But this move down that we have seen right here If you can know why it happened, then you can get an idea into, is it going to have persistence or not? And there are two things you want to think about. One, yes, the interest rate side is a key factor here. The other thing is you will notice that right now we have the largest sector, or the largest weighting in the index is tech. And you will see that tech is down on the day today 100 bips. Now notice that the broad tech sector is down and the SMH ETF is down 100 bips. But we actually have the IGV ETF outperforming that. And we were actually up earlier on the day at the open today. And now we're actually, it's, again, the IGV and SMH ETFs are a reflection of equity long short positioning right now, because everyone is short software and long tech. That is what the consensus trade is, which is one of the reasons why, I don't want to just get outright long this IGV ETF, but I do want to pick my spots in there, because I think that a lot of the stocks in there are pretty undervalued right now. And I don't mean stocks like Adobe or stuff like that. What I'm talking about is the whole Oracle thesis that I've had been laying out, which, in my view, they are really differentiating themselves. So they're actually turning into a lot less of a software company and a lot more of a hardware company. And so this rotation is the second factor that you want to think about for the entire move in the index. And once you begin to recognize that there's one, positioning pressure, and sure, there is some interest rate levels that you want to watch, especially as it relates to CPI. But when people just kind of blindly state, oh, interest rates up, equities down, it ignores all of the data that we've been having thus far in this entire trend. And so that's really what we want to contextualize and frame right here.
I really like that. And it goes to show you how you can start to see the ball a little bit more clearly today. Because if you go back 2 streams, we talked about exactly, I think it's 2 streams, talking about exactly where we're at right now and how we could see that becoming the thing. It's going to push everybody into thinking that yields are going to be the end of us. Pushes us down to the CPI level. It pushes, the things that I guess like Oracle is probably pulled back. I don't know, 7, 8, 9%, something like that. But it starts to help as a trader. I'm like, okay, well, this is actually really interesting. Now I can decide whether or not this is that spot where I want to take the other side and think that it's, hey, oil is not, oil is not making a new high. Interest rates are ticking up and shifting the narrative quite a bit. And, we got Warsh coming in. You could go back into that whole topic on how they're going to kind of guide things moving forward. But like, let's just say I'm not in the Oracle trade right now, and I've been thinking about how do I even get in this thing if I agree with the long-term thesis here? Well, these are those spots where it's going to feel pretty tough, but we've kind of discussed our way into think, and I'm kind of like, ooh, this is actually a spicy spot where I would think about adding to my position. And then the risk reward from like a trading perspective is even more defined now. If I want to like limit my downside and stuff. So as you're saying all this, I'm thinking about it through my like execution framework. And given that we've been here every day talking through this thesis, it's not even surprising to see where we're at right now. Really like it.
Yeah, I agree. I think that I actually forgot. We also have the Substack chat. Or I didn't forget. I have it up now. For everyone who wants to also, live stream on Substack, you can do that as well. And you can go in the Substack chat and put anything in there as well. Seems like some people don't like Larry Ellison as much. So not surprised. I think this is one of those great situations where it doesn't matter if it's Larry Ellison or the kind of entire establishment that we have with Trump right now. When I see someone who owns 40% of a company, I mean, who else in the United States owns 40% of a company that's in the S&P 500? Like basically no one. Right? It kind of tells you a little bit of a signal. And then on top of all of that, he is probably one of the oldest CEOs out there. who just continually takes massive bets, and he's literally swinging his entire, multi-hundred billion, almost $1 trillion net worth to take the entire company and make a macro bet that most retail traders are afraid to do. And this guy's out here with his entire net worth in an entire company swinging for the fences. And he's one of the greatest entrepreneurs we've had. And I'm sure people don't like him for that. But when you look through whatever the kind of the biases are and see the risk taker behind it, you can begin to see that, oh yeah, this is probably not a guy that you want to bet against. And yeah, I think that, Elon Musk said Larry Ellison was the smartest CEO. No, like every person that I've talked to who has interacted with Larry Ellison, it's always kind of funny. They're like, oh yeah, no matter what, just never bet against that guy. Because they'll be in the room with him and they'll be like, yeah, he's intense and he knows exactly what he's doing.
Also, come on, man. Like price drives narrative too, right? He was the richest guy in the world there for a hot second, right? And I bet a lot of I bet a lot of those guys would have had a different opinion there. But now that the company is down 60% and he's kind of back into the shadows, all of a sudden they attach Israel or whatever to him, and all of he's the most hated villain ever. But hey, watch Oracle rip to $400 and see if they have the same opinion. It's so funny how just price could drive people's opinions of things so much.
That's so true. Yeah, I agree. On when we're in this period of time, I think that this goes back to watching the forward curve, watching interest rates. We did a whole video last week on them, or actually this past week. What day is it? Is it Tuesday?
It's Tuesday, baby. Turn it around Tuesday. Where we all turn around and take it in our positions.
I know we talked about interest rates a little yesterday, and then we laid out the entire framework last week for them. So end of last week. But notice that, this move that we have seen in Hyperliquid, I've been laying out the bullish case for Hyperliquid ever since HIP-3 got launched, right? Basically here and volume started to scale up. I've laid out very clearly, go to my pin tweet, go to every single thing, the bullish case that I have. And that HER is the best expression of that. Now, we've basically moved massively on sides, basically from roughly $25 to 50. So we're almost up 100% in the Hyperliquid token itself. And then this is the short-term risk reward that I shared in the chat last week with, again, if you guys aren't on the website, go to capitalflowsresearch.com. You guys can see the entire breakdown of everything there. But I laid this out because I recognize there are some people who might not have known about every single thing that was taking place when we were back down in the 20s. And it's important to always update what is your risk reward. Where are we in that progression so that you can make an informed decision? And this was the risk reward that I shared. Why is that? Is because this information catalyst that we had the other day, where we began to see a shift in how exactly the flows are going to function with the Circle and Coinbase deal, how that integrates with Hyperliquid. And then on top of all of that, we have seen multiple ETFs get launched. That is, in my view, less about, there's going to be ETF flows now, and more about regulatory progress. And I did a whole tweet on that whole thread, talked about it a lot. The fact that we have now pushed higher at the same time as the other things that you would expect to go up with it is an indication about the uncorrelated returns that Hyperliquid itself is providing. So when you see things like this, the S&P 500 actually going down and Hyperliquid still going up, that sends you a signal. Same thing about Bitcoin. When people have talked about how, Hyperliquid can't really succeed unless Bitcoin goes up. Again, not really the case. I mean, there's a reason why you had Hyperliquid actually outperform and Bitcoin moved down. That should have sent you the clearest signal that there was a divergence. And that disconnect and correlation basically sent a signal to the entire world that value was being created. And Hyperliquid was making new highs right here. Bitcoin is still staying in this range. Same thing right here. My view is that Bitcoin's probably going to rally sometime in the next several months, but my entire goal has been to be long Hyperliquid, and Per as an expression of that, and that continues to be my largest bet. And if you've been following along with me, then you know that idea that I laid out. And again, one of the things that I've said is that we do not even have the ability to price the flows that could come if Hyperliquid gets added to the United States in a regulatory framework. We don't have the ability to do it because all of the largest players in the world that are the largest flows of capital that would price that are not even allowed to touch it still, which is why there's a reason why Per is up on the day today and it's actually outperforming Hyperliquid. And we just had another day on the hourly, especially if you look at where we're at with volume. We had 6 million shares, over 6 million shares. Someone come into the market and buy 6 million shares of Hyperliquid at the open, basically. And that's a significant amount of money, right? When you have 6 million shares and someone says, okay, I don't want to come in, I'm not going to, people are clearly buying the Per stock as opposed to Hyperliquid, which tells you that there is a value proposition for it. And 6 million shares, that's about $45 million at 750. So that tells you, again, that's just one day. We continue to have these volume spikes over and over. And by the way, the 6 million shares is actually just for in an hour. So someone just needed to hit the bid, and they need to hedge their risk because if it gets added, it's going to have an even greater melt up than it has right now.
Can you, by the way, I think that news that dropped yesterday, we haven't had really a chance to discuss it. And we're not a news platform here, but it's relevant to the bet you're making. So is there anything you could maybe touch on that a little bit with the SEC?
Yeah, let's do that.
I think the Kobisi letter had it.
We're not going to his account.
Okay. Somebody has a take.
No, I don't have any negative feelings. Let's see. We'll go to the other account that we talked about. Let me find it. Almost have it right here. Here we go. So right here, yesterday, 18 hours ago, U.S. Securities Exchange Commission is expected to release its so-called innovation exemption for tokenized stocks as soon as this week, according to Bloomberg Law. And the idea behind that and the breakdown behind that is that there could be an exemption for the entire space for those stocks and for perpetuals. The idea is that Hyperliquid would likely be the primary beneficiary of that. The idea here is that people have misunderstood how Hyperliquid fits into the regulatory framework, and that's to be expected because most people don't deal with regulation. They've never worked with the SEC, they've never worked with FINRA, they've never had to go through all of these complex processes of syndication and securitization, and they don't recognize that at the end of the day, if you want something to be integrated into the United States financial system so that it has its value proposition is used, especially in the financial industry, then you need to have regulation for it. And the issue with that, the positive and the negative for it, is that regulation is very slow. The two industries in the entire world right now, healthcare and the financial industry, have so many regulatory barriers that, well, it's actually financial industry, healthcare, and actually government contractors. Those are all the biggest barriers that once you get in terms of the regulatory framework, it's very hard to get out. And it's the same reason why someone can't just share your medical data online or share your financial information online. They just can't go do that, or they can't just share it no matter what. There's regulation behind that, which also means that you can have the entire AI space. It's very hard to integrate that into a regulatory framework because that is allowing data access, and you can actually, so for example, we've had this issue in the law space pretty significantly with AI. Lawyers will feed things into an AI to do whatever it might be, tasks or whatever it is for analysis. And as soon as you do that, then it's no longer under attorney-client privilege. And the result is that the opposing side can subpoena those files from OpenAI or Anthropic, and they have to give it to them, even though you're still under attorney-client privilege. And so it's, especially in a legal framework, it's functionally like posting it online because it can get subpoenaed, and it's not under privilege once you stick it into the AI. So that there is a lot of regulatory hurdles. For Hyperliquid, if you have it integrated into a KYC framework, so let's say the United States says, you know what, we'll allow it to be integrated, but you have to go through this KYC questionnaire, integration, identity, whatever it might be, and then you can use it. Okay, well, you're allowing to use it with some barriers. And again, the Hyperliquid Policy Center is going to have a better view, a more informed view on all of this. And, this is just my opinion, or these are just possible scenarios. I'm not a lawyer or anything like that, right? At least that anyone knows of. But in terms of the exemption, if it is exempt from that policy and that regulation, then the entire idea is that as long as you use that, it is not against the regulatory framework. And basically you create this very narrow thing where maybe you do sign some documents or something like that and have some KYC, but it basically says anything in this category, you can do whatever you want. Very similar to how, right now you can't tokenize something and provide an expectation of returns without it being defined as a security. And so that's why different types of NFTs or meme coins or stuff like that, they can't provide a yield, because if they provided a yield, they would be considered a security. And then if you're not registering with the SEC, it's considered, you can get sued or go to jail. So you always want to avoid that. At least I do. But the idea here is that if you have this integrated in and you get that exemption, then it would cause so much capital to go on to the platform within a 24-hour period. And man, should we start bashing these people? I will say this, FINRA and the SEC, they are government agents like everything else. All of the best and most high integrity firms in the world that are actually obeying every single element of the law that they can are in court every single year, or in settlements every single year with the SEC and with FINRA, or they're in constant communication to adjust things or whatever it might be, because FINRA itself is, and even the SEC and all these other government agencies, whatever it might be, they a lot of times have political agendas, and you have to go to court to actually bring it back to the law. People might not want to hear that or like to hear that, but at the end of the day, a lot of that stuff happens. So, that's why even today, it's tough to say, just given all the government corruption, to say that, oh, there's an investigation into this bank, firm, or whatever it might be. The fact that these entities, these government agencies, have not had integrity themselves actually just makes it so that when they do investigate someone, all of us think, everyone in the industry, it doesn't matter. I mean, maybe, people are watching headlines or whatever, but all of us know that there's an element where, well, maybe it's right, maybe it's wrong. We don't know, right? I mean, we already know how much waste and investment is in the system from Doge and Elon. And we all also know how many issues there are at the IRS and FINRA and all these other things. And so, it's kind of a boy who cried wolf scenario, because if they do an investigation into someone they actually should, then all of us don't even know. We don't know if that's the right thing. And so, again, this is this is why you have a lot of system problems in the system in terms of reputation. And that's actually why there's a value proposition for Hyperliquid, because once you actually have a truly decentralized mechanism for value creation, not just Bitcoin with as a store of value, but Hyperliquid that is actually has a value proposition for cash flow and adding value. Once you have that, then you begin to have this entire new paradigm, because the system itself doesn't have a reputational figure that can basically screw everyone up. And it's a market like anything else. And so that's one of the reasons why it's taken so long to get integrated into the regulatory framework. But it's also why that when it does get integrated, it is probably going to have one of the largest moats that exists. And I think that we were talking about this offline, but the fact that there's no marketing dollars in Hyperliquid, I just posted this actually. Where is this? Yeah, right here. No investors, no paid marketers, no fees to the dev team, no insiders, Hyperliquid. That's what Jeff posted in January 28th, 2024. And that really sets the frame of reference for everything that's taking place. There is not the same kind of issues that you would have with a lot of these other platforms that exist. And again, that's why other platforms connected to Binance or Solana or stuff like that, they're not doing as well. And it's for a very important reason. So if you think about longevity and robustness, Hyperliquid is really the only game in town. Sorry, I'm just trying to pull up this other. Where is this? Okay, so everyone knows, if you guys have been following along, if you guys are not following it yet, you can go to the Hyperliquid Strategies website for the per information, and you can go through all of the different changes we have. We're still at a 1.25, MNAV multiple. And, my view is that could trade up to, if they don't issue a ton of shares and only a marginal amount into that to collect premium, that you could have, more closer to 3 or 4 or maybe even 8 in the premium. And, the upside in my view is that we can move to all-time highs. That's kind of in Hyperliquid. And so that's kind of really the situation that we're in. I've laid out the per bet, and I laid it out for per subscriber, or for subscribers down here in the sub 3 range. I continue to hold my position. My view is that there is a lot more upside. I think that the more we have regulatory acceptance, the more we're going to have a move. Actually, I think I think we could have a pretty significant move, basically like this, where we just melt straight up in like XRP, like we did previously. And I think that would be a very interesting scenario if we had the Hyperliquid ecosystem melt up to $150 in the span of a month. I think that's kind of the scenario that we're in right now. And that's kind of the main idea that I've been laying out. On the decentralized side and how that connects to the macro side of things, the idea, this connects to how Hyperliquid is outperforming the S&P today, right? And the fact that S&P 500 is down and Hyperliquid, and specifically Per, are up. And that kind of connects into this larger macro narrative that I laid out yesterday. If you didn't watch the stream yesterday, I went through these two charts. You can see that there was some positioning premiums in the SMH ETF that was really causing everyone to be net long. And then we had a lot of premium in the IGV ETF that still needs to go down, in my view, and have IGV bid a bit more, but more about the dispersion that's taking place, because, again, NVIDIA right now has a massive call premium in it right now. And when you have that type of premium, we're still sitting at these levels until earnings this week. But the fact that we have that is an indication about how aggressive positioning is right now. And that on the margin, in my view, as Jensen comes out of this entire move with China and the entire meeting with China, I think that if you have him raise expectations around what they're doing as it relates to the entire China scenario, that's the primary litmus test that you could have for NVIDIA making a new high and the SMH ETF moving up as well. And then yesterday I went through the entire earnings setup. We had Home Depot. Actually, this will be important to talk about. Home Depot, they came out with earnings this morning, and they basically told everyone that they're guiding their earnings down and they're shifting a little bit of their spending. This connects to, okay, we have higher mortgage rates, higher prices, higher energy prices. How is that impacting the consumer? And we're seeing it impact the consumer in some places. We also have Wednesday, which we're going to see Lowe's and Target and some other names. NVIDIA is the main one on Wednesday after the close. So that'll be tomorrow after the close. But for Home Depot, that gives us a view into this period of the time lag that we're in. And I'm going to pull up this news report that just came out from Bloomberg. And, Bloomberg, Home Depot cut its full earnings guidance, warning that some unsteady consumers are hitting the pause button on big ticket home purchase items. The world's largest improvement retailer said that it expects adjusted earnings per share to decline 5% from a year ago, lower than its previous forecast. The company said its profits and comparable sales came in lower than expected in the last quarter, citing the overall weakness in the housing market and lack of storms that hampered demand, roofing, generators, and other categories. The company's shares fell a little bit after that. Its stock has dropped about 8% year to date, or I think through Monday's close, compared to the 13% increase in the S&P 500. Sorry, this is from the lows. And here is a chart of where we're at with, kind of their earnings. And you'll notice that Home Depot itself is directly connected to this entire idea of mortgage rates. So U.S. housing market remains frozen for a number of reasons. Even though mortgage rates are lower than they were a year ago, Americans have been reluctant to purchase as cost of living and economic concerns create new hurdles. Home prices remain high, meaning affordability is becoming a more out of reach for consumers. And so you'll notice right here, let me pull this back up, that, Home Depot, we're at these lows right here. We actually didn't even move down that much. We're actually flat on the day. But, Home Depot really moves in lockstep with interest rates. And this is a clear example of why you want to understand interest rates, is because Home Depot moves in lockstep with the housing sector, ITB. Now, you'll notice that the ITB ETF is down because interest rates have gone up. However, you will notice that the REIT ETF, which is all about how is, the cash, less about activity, because home builders are all about what are we building that's new. REITs are all about how are home prices functioning as it relates, or especially commercial real estate, as it relates to cash flow and its connection to debt. And you'll notice here, we had one of the biggest rallies in the XLRE ETF in 2021. Once interest rates began to move up, that moved down. And this whole period of time in blue, where we didn't make a new all-time high, even in 2024 and 2023, is because all of the commercial debt in the real estate sector was rolling over. Now we've moved up to a new high. Same thing right here. Even though we have higher interest rates, everyone has rolled over their debt in that sector, especially in the commercial real estate sector and for REITs, that we're being pretty resilient. So this divergence that we see here, where you are having ITB sit here kind of at lows, and then XLRE sit at highs and moving up, this divergence right here is indicative of the period of time that we're in, where activity has fallen a little bit, but are delinquencies rising? No. And so when people say, oh, well, delinquencies are rising or this is happening, that's happening. Again, if you look at the underlying data and what the market is pricing and look at what all the major companies are talking about, it's not happening. At the end of the day, all these people that are coming up with a bearish narrative about housing, what are they sourcing for that? They're basically sourcing niche local news and TikTok videos from people that are talking about how unaffordable housing is. And those people are probably at a point where they're actually not even figuring out how to go increase their income for that in spite of higher interest rates. And that's why we've actually seen a lot of all cash deals come in. Like when you look at the market and what people are doing, there's a reason why people have been buying more all cash deals than just getting a bunch of 30-year mortgages. So I think all those things are playing into this entire earnings season. And tomorrow is really going to be the big day for NVIDIA. On the NVIDIA side, and about this whole idea about chips, I went over and I put this this slide deck in the website. And if you go to capitalflowsresearch.com, go to NVIDIA earnings is the catalyst for this week. Scroll down, and if you go to these decks right here are all the decks from yesterday. You should go through the entire video, go through these decks. But you can also go through the deck that James provided, and then also the geopolitics one that I provided. This entire thing on TSMC right here is linked there, and you can go through this on your own. But the idea is that we are in an entire kind of situation between the US and China, and Taiwan is the asymmetrical linchpin for that. If China decided to attack Taiwan today, the entire CapEx side of the United States and all the debt that was issued around it and all these things that are happening, you would basically have it get a massive shock. The government would have to probably bail it out or something like that. But even if we progress forward and we have investment in the United States, remember there's a lot of fabs getting created in Arizona right now, which is helping rebalance some of the Taiwan side into the United States. Even if we do that by 2030, the majority of chips are still in Taiwan. That's why the entire dynamic with China is so important to understand right now, because China is connected to the entire AI CapEx side and the chip side in Taiwan. And that's connected to the entire outperformance and Mag 7 dynamic that we are seeing. If you want to know what could crash the market and move into a 3-year bear market, it would be the entire tech sector going down the hole because Taiwan gets invaded by China. And so understanding China's agenda, incentives, and mindset is very important as we move into this period of time right now. And so let me pull up the place that I want to go over today, and this goes to the title of today's stream, is all about, is China attacking global markets through economic warfare? And I want to walk you through all these things, and then we'll go through the questions that you have. And if you have questions about how this works, why the mechanics exist in the way that it is, how that functions, then put them in the chat and we'll talk through them. And again, this entire slide deck, if you want to go over this on your own, it'll be laid out on capitalflowsresearch.com afterward. So if you're not a subscriber there yet, you can go there. Everything is laid out, and you can get all of the updated reports, and then all the proprietary research is there as well for paid subscribers. And whenever the next bet is that I lay out, that kind of per 2.0, whatever that might be, I'll lay that out on the Substack for paid subscribers. The idea that we're going to go over is China actively trying to become the next world power and attacking global markets through economic warfare instead of kinetic warfare? And we are not going to argue about politics here. We're just going to go through and map the specific tactics and the structural mechanics and let the long-term data really answer the question. And so there are 3 major ways that China is doing this. And these are not disagreed upon facts. Everyone, doesn't matter where you are politically or anything else like that, everyone agrees upon these factors because they're objectively reflected in the data. Number 1 is the yuan suppression. They hold the currency down so exports stay cheap. Just imagine Amazon and how they have lower prices than basically anyone else. Why is that? It's because they can actually hold their prices down, carve out a market, and then use the scale to make money in a way that no small business could. That's what Amazon functionally does. If you don't know, I mean, and this is why they're a monopoly. If you don't know how Amazon works, they functionally come into any market, take their prices, put them below everyone else, carve out all of those other people, market better than everyone else, deliver faster than everyone else, and everyone just says, well, I'm going to buy it. I'm going to buy whatever Amazon has, even if I don't like Jeff Bezos. And that's functionally what we're seeing in China right now. It is a comparable thing. When they suppress their currency, it's functionally them offering cheap goods and services to the rest of the world. And everyone says, in order to compete, I have to buy it from them.
I think just on the Amazon note as well, there was a video that we've talked about a lot in our conversations by Sam Ovens about basically the structural moat and impossibility of competing with Amazon. And it was very fascinating, and I think pretty profound to why we maybe understand Amazon's Goliathness in the world. And I'll go find that while you continue, and I'll link it in the comments for people if they're interested.
Awesome. I appreciate that. So that's a great video, by the way, guys. If you guys haven't watched that video, you guys should definitely watch it. On the weapons that they're using is, number one, yuan suppression. So they're allowing cheap goods to flow into the world. The second one is that they're squeezing their consumers. So they're crushing households to subsidize factories and production. So basically, if I have $100 in the economy, I decide, do I allow the consumer to have that so that they can go spend it in the economy? Or do I take it and invest in more so that I can produce more goods and services? And at the end of the day, there is all money that is anywhere has to come from somewhere. And so you have to split that up somehow. And wealth is created as those work together, but in a large system, you can actually have active, especially when you control the currency, you can have active manipulation around that and subversion around that, which connects to the entire video we did last week on the impossible trinity and how that connects to that. So the China as a country is squeezing their consumer, and they're pushing everything into investment. And then the other thing is the rare earth chokehold. They have, really cornered the supply chain over the last 30 years. And, I think the only, and again, it's not even the main company or anything like that, but the only company I think that is totally just US based and is the play for that is MP Materials, that is not just based in China. And the REXM or RMX is kind of the global rare earth strategic metals ETF, which, by the way, you should be watching as it connects to SMH, utilities, all of these other names, because all of these are just moving in lockstep. These are all showing these risk on, risk off moves. All the same people are trading all of these, and all the equity long short guys are trading all of them long short because there's just so much opportunity right now. So back on this idea of what are the things that they're using, they're suppressing their currency, they're squeezing their consumers, they have more money to push into that. And then they have this geopolitical foothold, in a sense, of the rare earth choke point. Now, the question everyone asks is, can the yuan replace the dollar? And the narrative around this is always really big. People will say, you don't get it. The dollar's even replaced. Or you don't get it. Oil's being transacted in the yuan. Don't you get it? Saudi Arabia is transacting their oil in the yuan. Once you contextualize that and show the data around it, you'll realize, again, this is just the data. You'll realize how absolutely ridiculous that idea is. I don't make the rules here, okay? I'm just going through the charts and saying what's driving markets and why are things happening. And when you actually go through the data, you understand that the dollar as a reserve currency is not, here's the problem about the dollar and what people say about the dollar is people just say like, oh, it's only in people's mind. It's only reserve currency because everyone believes it is. It's totally false. If you want to industrialize as a country, what do? You export your goods and services to who? The United States. And as a result, you get dollars. And so that is one of the main things backing the dollar's reserve currency status. So when people say like, oh, the dollar is a Ponzi scheme, it's totally this misrepresentation, an arbitrary thing that people come up with because I can just say, oh, you think it's a Ponzi scheme? Okay, well, cool. Do you want to exit the dollar system then? That also means that you're not going to go work for dollars. You don't want your assets denominated in dollars, and you don't want the entire infrastructure that's built around dollars, which is global trade. So if you want to go without global trade, you don't want to have any assets priced in dollars, and you also, don't want any of the benefits that come with the dollar, aka geography in the United States, which is the best in the world, and also the entire, military defense system that you have around the dollar as well. If you don't want any of those, then sure, go move to another country and exit the dollar system. But there's a reason why people are coming to the United States and not other countries, right? I mean, we have migration everywhere, but this entire idea that the dollar is a Ponzi scheme or something like that, again, it's just not really borne out in the actual data, because there's a reason why global trade exists, and it's centered around the dollar. And so I think that's just one of the key things to remember kind of in this narrative. Again, this entire slide deck, it'll be at capitalflowsresearch.com. You can go through all of it. The entire goal of all these sessions, map the macro regime. That's what we're doing today. So you can understand how ridiculous some of these narratives are. And then you can go through all the proprietary research, not just saying, okay, well, here are these narratives that you shouldn't think about. But then we say, okay, why is that important to know for financial markets? And then as a result, here are the bets that we want to take in light of that. That's the entire goal of what we're doing here.
Also, just to add on to that, take the slide deck, download it, toss it into Claude or GPT or whatever, and have like a little bit of a description about yourself, your positions, your portfolio, your risk tolerance, all that stuff, and tell it, take the slide deck every day and redo a new slide deck and make it unique to me. Have it relate to exactly the things I'm doing and I'm thinking about and I'm positioned in, and you'll get even more out of this stuff. And that takes literally a download and a right click. And you can do that every day, keep it as a new project. It's amazing the stuff you're going to be able to pull from this.
Yeah, I totally agree. I think that if you're not personalizing every single thing for your life with the memory in your AI, you're basically behind the curve right now. James and I do that all day now. Any file that I have or anything I go through, maybe I'll read through it. It depends on what it is, but I'll always feed it into, like, at the very least, a reading program that I have to highlight things, pull things. I say, put this in my memory, put this in this file, put this in this file, and I'll go through it in that format. And again, I don't even know how to tell people how important it is to just spend all day on Claude Code right now. I don't know what else to tell people. It's just the most important thing that you can do, especially as we have this entire AI arms race, and it has global significance, right? I think once you saw that video around, this is one of the things that I think I talked about maybe a month ago on the global trade situation. What do you think happens to global trade if we can have robots that do all of this work for us and we don't need humans for it? I think those humans will find other jobs. But what happens to global trade when I can create a factory of robots that's cheaper than ordering stuff from China? What happens to the geopolitical foothold that people have in the world? I mean, you don't even know how significant that could be. Imagine overnight or over a year period, you basically have your boss come up to you and say, hey, we've realized that we can find someone way cheaper and we don't need to use you anymore, and we're going to start taking off your income every single month. What would you do? You would begin to do whatever it would take to get your income back online, because you probably have a family. You probably have people in your life that depend on you. And so what do you think is going to happen if something shifts and the robotics complex makes goods cheaper and people say, oh, you know what? Hey, China, we're going to go with someone else. You think they're just going to stand by and be like, all right, see you guys. Like, that's it. We'll see you guys later. Like, you think they're going to do that? Like, that's the context that we're in right now. That's the context for the meeting that we had in China last week.
That video, I can't stop thinking about how We will look back at that video of the robot and the intern battling each other with the packages.
Yeah.
I think that was a really big deal. I think that was like a monumental moment in history.
Right.
And it's like a joke, right? Ha ha ha, like he's got to sleep and like whatever. But like you could do it in your head. You're like, wait a second. Yeah, he's ahead a little bit, but he's going to have to go take 8 hours off. And you're like, there's no way long term this makes sense. Then you got to schedule him. He's got family problems. He's got this, he's got that. That was a massive moment, to your point.
Yeah. No, I agree. And I think that if you can understand these ideas right here, then you can understand why, a country as a whole is like a big aircraft carrier. It can't just take its wheel like a speedboat and just like flip it and be like, all right, we're just gonna flip around right here, pivot, like time to pivot, guys. Right? Like corporations can't even pivot as fast as individuals these days. And that's crushing them because they can't adapt fast enough. Right? Like that's one of the reasons why you have individuals a lot of time create more value than corporations. And so think about a country saying, oh, I need to pivot. They're going to be like an aircraft carrier that has to take a long time just to flip around in the right direction. Right. And then they're going to be way behind. And so countries know that. And so what they're always doing is they're always trying to adjust ahead of time so that they're ready for that. So that's why when we talk about things like the CCP, that China is holding its yuan down on purpose, that's a pretty big deal because when they're holding it down, a cheap yuan equals cheap exports equals factory jobs leave everywhere else. And so before 2014, the central bank did it openly. It bought dollars and sold yuans, reserve piled up. You had 3.8 trillion. The whole world could see it on a chart. After 2014, the IMF and US Treasury were calling it currency manipulation. So China moved the intervention, and then state-owned banks now do the buying instead of central banks, right? And they were smart. They said, oh, you know what? These narratives are probably not going to serve us very well. Let's just tell our banks to do the right thing. And we still see that because since 2014, China's run a $3 trillion trade surplus, and reserves didn't grow. And so that money has to be somewhere. And if you're saying, well, how does that exactly work? Basically, if you suppress a currency, it's the same thing as a corporation cutting prices in nominal terms. And this goes back to, we've talked about FX, interest rates, and things like that. When you have a FX position, you have to change that somehow. And you can either do that through state banks or the central bank. And what they did is they shifted from the state-owned banks from the central bank to the state-owned banks, or the banks that are, you can say, commercial banks. And now they have a massive trade surplus. And by the way, you can see that the PBOC, this is the central bank, their reserves have basically not moved. But here's the implied level that we're probably at as we are having this period of time. So think about this. Imagine if the Federal Reserve came out and said, hey, we're adding $5 trillion to our balance sheet. You would just go, whoa, where did that come from? What would it do immediately? It would cause the dollar to collapse. And then what would happen? The second and third order effect is that, oh, wait, the dollar is now lower. That means that every other currency is higher. And now as a result, if I want to buy something from China or Europe or the UK or wherever in the Eurozone or something like that, then it's now more expensive for me because my dollar gets me less. And now I say, okay, I'm going to take that dollar and maybe buy something in the United States instead. And so that's the entire idea of the currency. And so the thing that they're doing along with this, and by the way, actually, I'm going to sidetrack really fast. If you want to see how much China is really exporting, go to Brad Setzer's account. He's one of the best guys in the world that tracks all these flows because China manipulates their data. Here's the Chinese vehicle exports right now. And you can see that since 2021, they're going through the roof. So you have a massive amount of exports coming out of China right now in their vehicles. And then even if you just look at overall, what China is doing, you can see, let me see if I can find the chart where he shows total. total manufacturing right here, you can see that their manufacturing is really increasing a ton and their real estate sector is going down. And then the other thing that we have, Brad has such great charts on these. I just have to go find them.
While you're finding that, I remember sending you something about how they even add boosters to this, where they basically incentivize competition, see what the winners are, basically eliminate the competition after the winners are decided, then subsidize those brands to then push out even faster. And
100%.
I think it was like there were top 3 companies that were decided. It was like Neo and a couple other ones. And those are the ones that are being exported like crazy because they just said, all right, drop the other ones. We're going to subsidize and push the production of these winners because they're clearly the ones people want.
Totally. I think they're helping the creative destruction process move faster. And the expense of that is actually a lot of the consumer because they're doing that for global trade, right? When you see charts like this, when you see the amount of goods being settled, I mean, it's going through the roof, especially since COVID. This is why I've talked about how countries have a decision right now. If they try to run another recession playbook and, allow their economies to fall into a recession, China's just going to come in and say, oh, there's going to be some U.S. corporations that are going to go bankrupt. Great. Which ones are those? Cool. We'll just start building capacity for that. And we'll just start exporting goods at a lower price. And as they come out of a recession, everyone will buy our stuff. And these other corporations that we're exporting those, we'll just push them out of the market. That's why, and again, people will say, oh, well, just let free markets be free markets. Everyone likes free markets until the bully comes up to them and takes their lunch. And then they say, wait a second, where's the teacher? Right? Like that's the entire position that we're in right now. So I don't know if you were the bully or you were the kid that got bullied in high school or I don't know what it is, middle school or anything like that. But
I was somewhere in the middle.
You were somewhere in the middle.
I was Switzerland.
You were Switzerland. I think you probably navigated either one pretty well. But on top of all of this, China is crushing their own consumer in many ways to subsidize their own factories. So every economy has GDP, and this just talks about the GDP function. If you're trying to understand this, ask Claude to explain it to you. In China, consumption is much smaller and there's a gap. So basically, if there's a certain amount of money in a country, some of that money goes to invest. Okay, so let me give you an example. Imagine you make $100,000 and then you take, you have to make a decision. Am I going to take some of this and invest it back into my business to keep growing the business? Or am I going to go and spend some of it on stuff that I want for my house or consumption or something like that, right? There's a difference between investment, whether you put in a 401k or put it into, that goes to another investment function, or you actually go spend it at the mall, right? Or in some other capacity. What happens in China is that you have the majority of the money actually goes to investment. And so that all the money, because of how the Chinese government structured things, 38% is consumption and 42% is investment. And then you have 16% as government. The United States, go figure, is the opposite. It's 60, and actually these are 2024 numbers, is actually right now 68% consumption. So 68% consumption in the United States and 24% investment. That just gives you an idea about the differential that exists right now between the US and China, and why if that currency changes, this entire structure of everything could have a massive unwind. And so when you look at, okay, well, how much of household consumption is China versus the rest of the world? I mean, China has, just a much smaller share compared to every other country in the world, especially the United States. And China and the United States are the two major players on either end of the spectrum. And so the edge that they have and what they're trying to capitalize on is this entire rare earth supply chain. They told the world in 1992 that they were going to corner the rare earths, and 3 decades later, they did that exact thing. And the leverage is real, which is why some of these rare earth news events have actually been moving markets and moving the entire AI trade. I don't know if people have been watching those, but that's one of the things I'm watching in the Asia session really closely. And I guarantee you that that was talked about in the meeting between Trump and Xi. And so you have that global, the rare earth supply chain, and then you just have overall capacity where China has massively increased their capacity relative to the United States over the last, basically 40 years now, and it's definitely changed overall. And so when you look at, okay, well, where are we at with the rare earth race over this period of time? You can see in red, China has really taken a ton of market share. Now we're back over here. And so this is what frames this entire situation between the US and China right now. And it's why that, yes, the US has a dollar reserve currency status, but you also have this entire dynamic with Taiwan, with GPUs, the AI arms race. You're adding space into there as well with the space race. And so everyone is wondering how that is going to function. And those are all of the context for why these meetings even take place, which is why I'm going to be very interested to see how Jensen comments on all of that tomorrow. And so this brings us to the entire idea. Can the yuan actually replace the dollar? And the math just says no. You hear this idea of, oh, well, there's BRICS expansion, petro-yuan deals, sanctions on Russia. The narrative says that the dollar is dying. So that's what you're going to hear even on Twitter, which, again, guys, we're seeing, CCP agents come out as, on boards of different, government municipalities and stuff like that. You don't think they have accounts on Twitter running? I mean, just think about what's taking place here. When you have this dynamic between the US and China, everyone is going to talk about, oh, the dollar is going to get replaced. But when you look at the actual data, you have all these things putting some pressure on. You're saying, okay, here's the narrative side. But when you look at the actual US side, it is continuing to be the largest reserve currency at 58% of reserves. If anything is taking over, it's going to be the euro, which, that just is insane in itself, given how cooked Europe is. For some reason, people don't like to acknowledge that. And then Japan is probably next, and then maybe the pound, and then maybe other G10s. The, renminbi is way, way lower than that. And that's one of the most important things just to recognize is just that, they're going to say, oh, the, share of reserves, or they're going to say there's a 50% increase in invoicing in the yuan or something like that. When it's like, oh yeah, we just went from 2% to 2.5% or something like that. And so you can go through any of the papers on the IMF. They have great papers on how this functions. The dollar remains a reserve currency. And the reason for that is, yes, as it dropped over time, yes, but the yuan has not really increased that significantly. If anything, the euro has increased significantly. And this frames where we're at with everything, because if you understand that the world is priced in dollars and functions on dollars, then you will understand how exactly that frames the relationship between the US and China right now. And so, is it economic warfare? Yes. 3 weapons are firing, and the one in every headline that people are talking about is not working, is jammed, basically. So China is not yet the next world superpower, but it is using every structural lever it has and to try to become the current one. And that's what the long-term data shows. So you can argue about all the politics, or people can come up with all these narratives or whatever it might be. When you look at the actual data, and again, the data and the dollars in the market are going to send you a signal about what people actually think. When people say, oh, there's narratives, or there's this or that, when you don't see price, this is why I don't believe in like sentiment surveys, and they just don't even work today, especially today, right? You look at a sentiment survey, it just tells you absolutely nothing. But when you see something where someone actually has to put money on the line, then they actually think a little bit more important. They think a little bit clearer. So you have the yuan suppression still, which China is doing right now. They're squeezing their consumer, and then you have the rare earths kind of market where they're trying to have, a bit of edge. And then you have the dollar substitution idea. That's not happening, but that's what everyone is doing. What? They're focusing on that. No one's focusing on the yuan suppression. Think about why that is. Why isn't everyone looking at the most important macro factor in the world right now of the closed capital account and yuan suppression? If they did, then that would totally shift how all the narratives are functioning. But people don't want to do that for some reason. Wonder why. You can kind of fill in the blanks in the back end about why that narrative is just always pushed down, whether it's by the media or whether it's just by just everything on social media. All of them are not really talking about this. And this is probably, in terms of macro, one of the top 3 factors in the entire world that is driving global markets is the yuan suppression. No one wants to talk about it. And so all of those things are going to become more and more important as hardware merges with software and AI accelerates all of that. And so again, if you want to go through this entire slide deck yourself, it'll be laid out after the video at capitalflowsresearch.com. And I'll be going over more paid research today as well. But the main takeaway that I would encourage you to think about is, how exactly have I misunderstood the situation with China? And how can I begin to shift my perspective and begin to understand global markets in a new way so that I'm not the one caught off sides if there's any positioning shift or there's any change on a structural basis? And so that is going to be one of the main things over the next several years as I'm publishing research on the Substack. If we start seeing warning signs for a yuan revaluation or a change in this entire AI arms race or something like that begins to increase the probability of a bear market, I'm going to start publishing research on it, right? Like again, if you talk to people in the industry, especially that publish research, every single one of them will tell you, well, I kind of just have to be bullish because if I don't, my boss will just tell me that like I sound too much like this person, or it just doesn't really work well for clients because we don't want to scare people. And we need to gather more assets. And if we just put people in cash, it's not going to work because we'll underperform. So in itself, I don't have any incentive to do that. For me, my entire goal is to make money in markets, whether that's long or short. Or, sometimes that is being cash, but a lot of the times it is being explicitly long or short. And that's my entire goal. And so I don't have an incentive to say like, well, I'm not going to get bearish equities, right? Or I'm not going to get, bullish or bearish bonds or gold or so, I don't have anyone, in the background that's saying like, hey, you can only talk about this, you can't talk about this. And I think that's just one of the most important things, especially as we're moving into this cycle right now, where there's a lot of money getting thrown at a lot of different monetization, media ideas, market ideas. And, I think in many ways, and kind of the same way we had FTX have so much marketing money thrown out there. I mean, they had, ads with all the top celebrities in the entire world. We're going to have another moment like that, in my view, with all the marketing dollars being pushed at everything right now. The question is just how it's going to play out. And so I just think it's important to kind of pick your spots here, know kind of the incentives, and be able to make informed decisions as we have that in the backdrop.
Yeah, just remember, we always talk about this vaguely and directly, is about how do we increasingly bet on ourselves moving forward, right? To take all of the responsibility onto our individual shoulders and make big informed bets. And it's like the benefit of not being a investment advisor or working at a firm is like you don't have all this weight of worrying about the results of others. Everything just revolves around your specific situation and what the best thing for you is. So cash could be a position, long could be a position, short could be a position. And I just think like that's what's most exciting to me. And that's what scares me about letting my capital go to some locked up fund or joining some sort of group where it's more of an echo chamber, or building up a Rolodex of people who want me to manage their money, right? I always get that with people I meet and they're like, hey, do you like, oh, so like, what should we do here? What should I invest in? Or like, and I'm like, nope, absolutely won't discuss that with anybody. Won't entertain the idea of bringing on capital because I just want everything to rely on me and my own situation and to ride or die by that.
Yeah. Yeah. I think that's really good. I just think I'm always looking for people in my life to push me back to my competency and take accountability instead of just telling me like, hey man, you should just depend more on me. I'm just like, what? Why is that? Right. I just think that's one of the things that I always look for. And I think just if we're in a period of time where high agency pays you so much money. I mean, it's just insane how much money it pays you because people have kind of been so lulled to sleep in the modern world of just comfort. And I just think there's so much opportunity to take advantage of it. So I think all of these discussions that we have every single day are just so critical around that. I know a lot of these questions that people have. I know we've covered a lot of complex topics or in-depth topics. And, the entire goal of these sessions is to simplify them. So we're going to go through a couple questions, and then we're going to cover how it really synthesizes to where we're at on this idea of what are the kind of narratives out there that are adjusting and moving around as it relates to these flows of capital, and how should we think about them? So we're going to go through both of those. James, what questions should we kind of touch on first?
I think this one makes a little of the most sense here because it's so real time, right? Everybody's seeing the yields go up. Everybody's going to start thinking about how that's going to crush this debt-ridden economy and go back to saying we have $40 trillion in debt, yada, yada, yada. So could you help simplify what is dragging on equities? Is it because the treasury yields are up? And is it because of inflation?
So the yields going up today are 100% part of that. Notice, though, that we covered this at the beginning of this live stream, so go back and watch this entire live stream. Notice that we have moved up so significantly in equities, and rates moving up marginally on the day and equities pulling back. Is part of it due to interest rates? Yes. Notice, though, that we're still above the CPI level right here. And so, we're at this interesting level, and notice that we're still holding momentum, right? We've had 2 down days. That's a dramatic difference from what we're seeing in rates, right, or in bonds right here, and interest rates going up. And so when you see this type of thing, why didn't equities get dragged down right here or right here or right here? Now it's only on this basically single day right here. So, and I talked about this for paid.
We're down 2%, by the way. Just I want you to know it's 2%. After a 19% up move. So you should be worried.
Yeah. It's, I told people, hey, listen, if we're really overbought at these levels and we're at these levels, we have positioning like this into NVIDIA. If bonds sell off a little bit, it could drag on equities intraday. And what are we seeing? We're seeing that exact thing. So this goes back to be at the live streams every single day, go through all the research that I'm putting out so that you can understand in foresight when I say, hey, listen, if bonds kind of move down and begin breaking this level, is that going to move equities into a bear market? No. We have some discontinuity in where we're at versus 2022. However, could you see it pull back and drag on equities or cause equities to underperform a little bit on a short time horizon? Yes. But do I want to get short equities? No. That sounds like a horrible decision. Again, that's one of the reasons why I'm long Hyperliquid and long PER, because they're outperforming as bonds and stocks are moving down. And just think about every hedge fund manager in the world right now that's looking at Hyperliquid and they're holding a stock bond exposure and they're down on both today. And they say, well, I'm holding all these stocks and they're down on the day. And they say, oh, wait a second, Hyperliquid's up. Man, maybe I should add some Hyperliquid exposure so that when stocks and bonds are down on the same day, Hyperliquid's probably up. Whether it ends up working out like that or not, that's what people are literally thinking when they see moves like this in Hyperliquid and also PER. And that's why PER is outperforming on the day, because people recognize that, oh, do you know what? I should probably buy some PER today, or I should probably buy some PER so that when stocks and bonds are up or down and PER is up, it's helping offset some of that drawdown that I have. I mean, these are the questions and the things that every money manager is always thinking about.
Also, you really got to be dialed into the economic calendar, right? I mean, if you've been around trading the last year, you understand that we have had many times now, many reps where we have strong rallies into big narrative catalysts, right? The NVIDIA earnings, every time, it's like the weight of the world is on Jensen. And we'll have a run up and we'll have a couple days where positioning unwinds in preparation for this or for CPI or for FOMC. It's the same thing, rinse and repeat. And it's not like you could rely on it, but it should make sense to you that if there was a day where yields pushing up could weigh on it, it's the day before the NVIDIA earnings on a Tuesday after a significant euphoric run up in equities, right? It's not that hard to kind of think about that when you've seen it over and over and over. So anyway, we'll
I want to cover this other question actually really fast. Okay. I think I can cover it. If I move, let's see. Yeah, I think it's on a Tuesday. So this is on the Substack chat.
Significant euphoric run up in equity.
This is
right? It's not that
this is
hard.
This is literally, and again, I don't know this.
You just mute that.
Seen it.
Sorry. Over and over. Bottom left.
Over. Yeah. Thank you. I don't know if this is true or not, but when I see someone like this, here, FX expert, MBA at the top 3 business school, China will become the next world superpower. I just think, how much is China paying you right now? Because no one.
It's Eileen Wang.
No one with any like reputation, like you're discussing at like a Columbia business school that China's going to become the next dominant force and BRICS is the next thing. I mean, again, if you really think that's going to take place, go build a business and see it collapse. Because I guarantee you, if you put any money behind this, I mean, this is the problem with universities today. If this is the stuff they're teaching you, then China is doing their job and of infiltrating the United States. But I mean, just think about where we're at right now. I mean, I would not be surprised to see a ton of people, in the entire, economic system, just misunderstand where we're at with China, just because they're continuing to push these types of narrative where they're saying, oh no, we know that China's going to be a dominant superpower. Look at this, look at this, look at this. And you're just looking at them and go, you've never taken any risk in your life, huh? You've never put your money up to actually understand a view precisely, because if you tried that, you would realize that there's just no bearing in reality with that. And again, that goes back to go to the actual data. And again, if Harvard Business School and Columbia Business Schools are talking about how China's going to be the next superpower or something like that, I mean, clearest top signal for universities. I'm not really sure what people are thinking these days of saying like, oh, well, the highest potential thing that I really want to do is go to university. I mean, what? Have you used any AI? Have you taken any risk? I mean, it's just not. It's just kind of almost like laughable by entrepreneurs now when you ask them, like, if you ask like an entrepreneur who's running a business, what university should I go to? They just look at you like, I don't understand the question.
Cute girls and fun parties, though, so that's worth something. I think you're so right in the idea that you need to take, like, there is no consequence to that person saying that thing because they don't have the risk on the table, right? So there's no consequence in that person being wrong, right? But if they had a massive position in this and then they were wrong and lost money, they would have to go reflect on what they're saying, or else they'd just go broke with their idea, which is, sure, you could do that too. But that's why we're always talking about, you need to have skin in the game. This is why I hate paper trading. Like, look, if you need paper trading to learn how to execute and learn the buttons and stuff, sure. But you need to get skin in the game ASAP so you can start to reflect and learn and push forward and push your comfort zone and learn where your boundaries are. And, I just, this question is a perfect example of somebody who is not living by that and is never going to be an outperformer.
Yeah, I agree. And then I also add, Naval has this great section where he says, go when you're thinking about getting feedback or going and talking about the quality of ideas, you always go to people who are getting their feedback either from a market or from math or some type of hard science. If you're getting your feedback from other people's opinions, then it's just always going to be very low consequence work, right? I mean, that is what university is was this paper a good paper? I don't know. What's your opinion on it? I mean, it's the most arbitrary way to, be able to adjust and create feedback in a system to make good decisions. And so I think that's just one of the most important things to kind of understand. Find a feedback mechanism that is based on first principles, engineering, or math instead of other people's opinions. And that's when you're actually going to take informed iterations. Because at the end of the day, in a university, everyone has their own opinions about stuff. Nobody has skin in the game. And if you keep taking feedback from all these different people, they're just going to keep telling you wrong answers in a different direction. And so I just think that's a incredibly important thing to think about.
So I'm a little unsure of the wording here, but it seems like you always have in your bets, the risk is very clear. But how are you looking forward and setting your reward expectations?
So I'll say this in a couple of ways. First, at the end of the day, if you know your risk, that's all you really need to know. If you know your risk and you know that your reward is probably a little bit more than that, or at least 3 times that, or whatever you're going to calculate for your hit ratio, then that's the most important thing to understand. Second, if you want a way to kind of quantify that, just run a projection on a rolling correlation basis. So basically say, oh, if stocks and bonds are going to do this, how do I triangulate based on my rolling correlations where it can be? So you just ask Claude, hey, based on my rolling correlation, if interest rates move by X, Y, and Z standard deviation, where does that put equities? And then you can understand, just based on its correlation to other assets, what is taking place. In terms of other things in markets, I would say you have some type of ability to map the strength and momentum. So you can just have, basically basic standard deviation stuff. But what I would say is that if you can develop some type of edge, informational edge into why why a risk reward takes place. Why is it that I have a certain risk parameter? And then how do I get a multiple above that? How exactly do I define risk reward? And, the risk perspective is that, or in terms of the risk perspective, you want a high signal to noise ratio on where that is placed. But at the end of the day, you're trying to get on sides a lot and hold things beyond the time frame that you have. And that's how I think about it. There is no perfect mathematical equation for your upside reward of like, oh, if you just, stack this, I don't know, what are those things called? What are the things that draw lines up? The Fibonacci numbers? Oh, well, we have our Fibonacci numbers. There's no perfect way to do it. It's about information, in my view. And I have ways of doing that based on the information I have that I don't share. But overall, what I would say is that you want to develop an edge, an informational edge around why something needs to trade higher than lower, instead of, I don't use Fibonacci stuff or whatever that, I don't know what people are using these days, honestly. So that's how I think about it.
But bro, everything in nature is a spiral. So why wouldn't your exits be based on that too? Right?
Yeah, everything is self-replicating, just like your failure too, right? Oh wait,
that's right.
Let's not apply it there.
It's reflexive. Okay, quick couple questions in regards to hype. Good question here, Joseph. What outside of staking from the partners or revenues and fees, what are the main drivers of the hype token that can push it upward?
I mean, I'm trying to understand the question. The hype
I think he just wants to know, what are the main drivers that could push hype higher? Like what are the reasons that value accrues to the hype token?
At the end of the day, the hype token is driven by assets on the platform generating fees. That's all it is. So you have all these assets right here in the HIP-3 market generating fees. And what you'll notice is that crude is actually taking a lower fee now, lower percentage. Notice that that's dropping. And what's taking a higher percentage? It's things like stocks. And that makes sense because the S&P 500 and the stocks in that, one, Trade XYZ is listing more, and two, we're in a melt up. So you would expect that to take place. And crude is not really moving around. So the leverage in that is slowly migrating back to stocks, which makes total sense. But what I would say is that at the end of the day, someone needs to come in and buy and sell an asset on hype for it to generate fees. Those fees get converted into buybacks, and those buybacks, buy back the hype token. And as a result, the token will go up. People also need to buy that token, whether it's for staking or rewards or, to get discounts or whatever it might be. But at the end of the day, the hype token will go up if more assets are traded on the platform with more volume. And as more assets get added and as volume increases in those assets, that systematically drives up the price. So I don't really care about people talking about like, oh, I'm, this whale wallet, this or that, this, right? Like all I care about are what are the systematic mechanics that are creating more assets and perps on the platform, which are driving fees. And HIP-4 market is also, that's what is creating revenue right now in the HIP-4 market. So again, you have 87 million in volume, 158 in fees. So that is kind of same thing here, right? Here's your HIP-3 volume of 61 billion, right? And then here's your HIP-3 open interest, right? And you will generate fees based on that number. So if this number goes up, the volume and open interest, that will continue to create cash flow for Hyperliquid and systematically buy back the token, which pushes up the token price. All of these other things about, I don't know what else are people talking about what's driving the hype token. The regulatory side only helps. Okay, let's say Hyperliquid gets added to the US regulatory framework, but it's a horrible product. Then it doesn't matter if it gets added to the regulatory framework or not. If no one uses the protocol, then it doesn't matter, right? Because it's not going to generate fees. That's why when people are like, oh, well, if this gets added, then other ones are going to get added as well. Yeah, and people aren't using those right now. So what makes you think that they're going to use them once they get added to a regulatory framework, right? You have to create the value first and then the customers come. Not this, again, more people in crypto and creating companies have a Ponzi mindset than the actual US dollar, because US dollar is actually used to facilitate global transactions and trade and actual value creation. Whereas like people are just saying, oh, if I get customers, then like I don't need to create value because I have customers. And it's just like, yeah, that's not really the way it works, right? The whole idea of a network effect that Peter Thiel talks about in his book is that there needs to be pre-existing value so that it's a flywheel effect as you add more people, but there's always a baseline value that even if that one person would come on to the platform, even if there's no one else on there. So if you want a true value proposition, right, this goes back to, how does a network effect even work? A network effect has to exist because there's pre-existing value. So basically I would come onto a network, even if I was the only person, I would stay on there because of the value. When you add people, that only exponentially increases the pre-existing value. Most people just try to add people and hope for the best and don't create value in the first place, which is why crypto is not doing that well right now, and Hyperliquid is the only winner. So that's what I would say about Hyperliquid.
I would add just a couple things if that like from
Please,
a more philosophical perspective is like, what is Hyperliquid trying to do? They're trying to create the house of all finance to where Joseph Gandolfo, sorry if I'm butchering your name, will say, look, I could just do everything in Hyperliquid. I could just do everything there. I could trade my leveraged perps. I could buy spot stocks. I could buy spot crypto or most of it. I can trade any of these tokenized assets that I'd like. I could go do prediction markets on there, and it's all on a front end UI that's backed by huge liquidity, and the network's growing, and all the fees, pretty much 98% of them or 99% of them, go back into buying the token. And by the way, as more and more markets get added, as more and more institutions buy and stake hype, that takes more and more supply off the market, which of course, higher prices cure higher prices. But in the end, the more hype you lock up, the more and more kind of driven the bid is, right? So I think if you look out into the future and you say, what is going to be the things that people care about in a year? Well, we've discussed why we think perps are going to grow into a massive opportunity, kind of already are, and prediction markets. Well, that's exactly the direction they're going. So as long as you see this all continue, and mind you, again, this is with no marketing dollars at all. They have a policy team in DC now. They have treasury, hyperliquid treasury companies with bids flowing in. All of this points to me to a higher token price.
Yeah, agreed. I think that's well put. Well put.
Bitcoin has a correlation with IGV. This has been a narrative also that's gone around. If you notice, by the way, before I let you answer this, Bitcoin always has a correlation to something until it doesn't. And then we, remember that M2 chart, right? All of a sudden the alligator jaws opened up real hard on that one and nobody talks about it anymore. So now this one is, it's we should have seen it before. It's correlated with software, but Bitcoin's a software. It makes total sense. Do you believe in the idea that as IGV can get its footing, if that's your view, can Bitcoin go follow that and put it at a higher high and resume its bull market?
Listen, I think that 2021 was all about a monetary driven cycle. And that's why we had everything just rip. That's why I had Bitcoin outperform so much. And we had such an aggressive melt up without we had some innovation, but it was more monetary, right? And now what we're seeing is a lot of innovation. And we're seeing some monetary things help, but it's a lot of innovation. And so now it's all about this disruptive and innovation flows. And the credit cycle is helping facilitate that, but liquidity is not as strong as it was in 2021. However, liquidity right now, let's just use an arbitrary number. Let's say liquidity is at level 5 right now. And the AI disruption and retooling of the economy and all these other positive things that are taking place is at level level 10. And if you take those numbers, add them together, you're like, all right, we have a 15 or something like that. Back in 2021, you maybe had innovation at a 10, right? And I'm sorry, you had liquidity at like a 10 and innovation at a 5. There was some, interesting SaaS stuff coming out. You had a lot of goods getting pushed through the system. So you had a different composition of the drivers. So the entire driver in 2021, when we had the Bitcoin moves, was all about what? Number one is macro liquidity being the primary driver of everything. And number two is, I think, the fact that you had every single global mechanism increasing that at the same time. The rally that we had from the 2022 lows and why Bitcoin rallied from then, I think a lot of that has to do with, one, yes, we also had macro liquidity begin to expand, but also you had the financialization of Bitcoin fundamentally change, which is why we had so many treasury companies increase. We also had so many ETFs get launched, and we were retooling the microstructure around it. Now, over the last year and a half, we haven't had anything new to help push up the Bitcoin price. And then you've actually had everyone say, well, liquidity is expanding, but not as aggressively as the past. And everything that is providing the best return is in this entire AI space because you can't afford not to be there, right? Like if you get fired from your job because of AI, then you don't have any dollars to buy Bitcoin, right? So if someone says, I need to invest $1,000, what are you going to invest it in? Are you going to invest it in Bitcoin or learning more about AI so you can keep your job to keep generating dollars? every single person is going to say, I'll invest in AI because maybe I will buy Bitcoin in the future, but what I have to do is preserve my ability to keep producing dollars. And that's why it's, and I think that's why it's correlated with software, because the same thing has taken place in software, right? There's been less, utility on a relative basis than there was 6 months ago. And I think now we're seeing the winners emerge and losers stay where they are, which is why we have CrowdStrike, Palo Alto, all these other names begin to rally, and why I think that Oracle is going to rally next. So that's how I really frame that situation.
All right. Some good questions today. We're about to go a little bit all over the place. First of all, I'm also in San Diego, so shout out, Sana. But we had a lot. It's interesting. We have a lot of questions today on is the market going down due to inflation? So you could tell, this is the stuff I pay attention to, is like, what is the day's narrative? What's the week's narrative? And you can see it developing, and I'm just going to pop that into the back of my mind to keep that there, as to like, that's where a lot of people's mind share is at right now. And I think that's, if you guys aren't doing that, that's why you could get stuck in a doom scroll too. But I think that's just super interesting. Tidal Wave, by the way, we've seen you a lot around, so thanks for coming and supporting. It's awesome. He likes the Nikkei long here. We've talked a little bit about this yesterday. So what are your thoughts on that and moving forward here? Actually, I'll add a little bit to that. Sorry. He has a second part. Nikkei vol is high and rising as well, and metals down in unison, looking for a snapback to all-time highs, even though U.S. growth seems not as strong.
Can you star both of those?
Yep.
Thanks. All right. Oh, per new high. Thank goodness. Let me pull up the Nikkei right here. So, and let me.
No, you're good. By the way, like what I'd like while you're looking like that, I think it will be. This is what I love to do here with these streams, is because we're kind of discussing levels, discussing rates or whatever. So if we do happen to see equities bounce off these lows here, IGV continue to go, PER continue to outperform, and when we get to Thursday or Friday and we're higher from here and we're hitting all-time highs past Jensen and all this, you guys should start to think about what we discussed Monday and Tuesday and how we got there and how that would be possible. That's how you stack all of this stuff on top of each other.
Totally. I think that's good. All right. I think on the dollar yen side, let me just invert this. So I don't want to confuse people. Hang on. Let me just add the yen contract.
Now go ahead. I'll finish with this just to add on to our last question. This is actually a great point as well, where you're going to be able to use cross-collateralization on hype between all sorts of different things. That's also a great point.
Oh, 100%. I think what should I say? I think that trying to think about what not to say. I think that the cross-collateralization with HIP-4 is going to be really interesting, because you don't have on other prediction markets, for example, Polymarket, Kalshi, stuff like that. You don't have the ability to trade a contract against an asset, right? Like, let's say I have a CPI view and I want to price that, or I have a rate cut view and I want to price that. I can't trade that against a SOFR and cross-collateralize both of those. Once I can, then you are going to have those entire markets change. And so I think that's going to be really interesting to take place. It'll definitely bring a lot more efficiency, and it'll allow you to create a lot more unique bets. I think there's going to be a lot of interesting things in the HIP-4 market that are going to bring transparency and show. Here's the funny thing that I think is going to take place is Kalshi and Polymarket have done marketing to integrate betting markets in the entirety of global society, US society. So basically, if you say betting markets, people understand that, especially young people understand that better than they understand equities, right? If you say like, oh, there's this SOFR contract, they're like, I don't understand what a SOFR contract. Well, just think about on Polymarket how you have a bet that settles to this or this. And they're like, oh, got it. Okay. So Kalshi and Polymarket have done all of the education to help people understand what betting contracts are. Now, all it takes, and we're already seeing this, is a couple lawsuits, a couple questions, a couple things that begin to say, hey, hang on a second. Who's creating these contracts? And how do you guys create those? And why isn't there a little bit more transparency about how those are created? And, how does the information settle? Is there any insider information just being part of Polymarket or stuff like this or that? How does that work exactly, or Kalshi or whatever it might be? And you begin to ask questions, and then you just say, well, you know what? I don't know. It just seems like there's more transparency and clarity on Hyperliquid and HIP4, and I don't have to worry about a celebrity getting insider information and being able to make, millions of dollars off of me just because someone at Polymarket or Kalshi tells someone about something else, right? And so, there's always going to be insider information, but the question is there transparency around how that is taking place? So, final thing that I want to go over right here is on the Nikkei side. I'm watching the Nikkei really closely because, we had the yen moving down right here, I think is going to continue to push the Nikkei up. I know we've had this certain correlation here that we've had over the last, while. But overall, this move down in the yen has pushed the Nikkei higher because it's all about government spending, Ministry of Finance. So yes, I think the Nikkei is going to move higher. I agree with that. I'm actually looking for the Nikkei to move to the yen to move to new lows. So this is just the yen future contract. I would look for that to move to new lows, or at the very least, just stay in its range. I don't really want to see this move up. That's kind of the, especially if rates begin to shift as well and cross-border flows shift as well. So I don't think that's going to happen. I think the Nikkei is going to move to new highs. That's really my view right now. And I think that as that happens, you'll probably have metals also catch a bit as well. So those are the macro views for everything for today. James, any final thoughts before I go through kind of where everyone can get the slide deck and everything else that we'll cover?
No, we ran long today, and I think it's just because, man, people are getting to really dial in on kind of using what we're doing here and asking great questions. And when we get to go back and forth, I feel like that's where we provide the best value for everybody. Totally. So I'll save my slide deck for tomorrow. We'll work through some of the trading archetype stuff. So make sure you guys tune in for that. But for now, I think just keep it out. There's really interesting stuff out there, and then make sure you follow everything that he's doing. If you can, share some of the stuff. I've been taking some of the capital flows. If you go onto his website to the free primer section, which he talks about all the time, I've been going through taking those and putting them into Claude and creating like a Eli 5 slide deck for those, and I'm posting them on Twitter each day. So you could either follow me there, he reposts them as well, or do it yourself. Either way, there's the risk on, risk off primer from today. Tomorrow, I already have one scheduled for, I can't remember what the topic was, but there's just so much out there. Stack it on. And, in a few months, you'll be so much of a better executor than you were before.
I love it. All right, everyone. As you know, everything will be laid out on the website afterward. We'll continue to do these live streams. Tomorrow morning, 8:30 a.m. Mountain Standard Time, we'll have the next live stream, and we will catch you guys then. Thanks for joining.